while the world was celebrating what looked like a historic breakout in silver prices on Monday, a very different kind of activity was unfolding deep inside the shadows of the financial system. This was not trading. This was sabotage. Late last night, under the cover of darkness, exchange officials and the executives of the largest bullion banks convened an emergency session. What they saw terrified them. The free market was about to bankrupt the institutions that were supposed to control it. Silver had decisively broken above the $75 level, and internal risk models showed a near vertical trajectory toward $100 at that moment. The cartel faced a choice. They could accept their losses and face insolvency, or they could change the rules of the game to steal wealth from the public. They chose theft. At approximately 3 a.m., a notice quietly appeared on the exchange website. There was no press conference, no breaking news alert, no public explanation. But its impact was immediate and devastating. The exchange announced a margin requirement hike of unprecedented magnitude. This was not a routine adjustment. It was a weaponized financial strike designed to force retail investors out of winning positions. The banks couldn't beat the market, honestly, so they pressured the referee to rewrite the score mid-game. To understand the scale of this betrayal, you need to understand how margin actually works. When traders buy silver futures on the COMEX, they do so using leverage. A relatively small deposit controls a much larger position in silver. That leverage is the foundation of futures trading. Under normal circumstances, it allows for liquidity and price discovery. But last night, the exchange abruptly doubled the cash required to maintain open positions. Imagine buying a house, signing the contract, and then receiving a call the next morning saying you must pay an additional $50,000 in cash by noon or lose the property. That is precisely what thousands of traders are experiencing right now. Margin calls are flooding in, not because the price collapsed, but because the rules changed overnight. This is a forced liquidation event, engineered to create artificial selling pressure and protect bullion banks, particularly JP Morgan, from insolvency. But even that was not enough to stop the buying pressure. Reports are now emerging from multiple brokerage platforms that buy orders are being restricted or disabled entirely. Error messages are appearing. Risk limits reached. Liquidation only. Traders are being told they may sell, but they may not buy. This is the same tactic used during the GameStop crisis. When buying is removed but selling remains, price discovery dies. The only possible direction is down. This is not a free market, it is a controlled demolition. Demand is being deliberately suppressed so banks can cover naked short positions at discounted prices. This is market manipulation in its most blatant form. While retail investors are restricted, banks unleash algorithmic trading systems to manufacture fear. This morning, massive sell walls appeared on order books, blocks of 5 million ounces offered at specific price levels, designed to terrify the market. But these orders were never real. This tactic is known as spoofing. The banks placed enormous sell orders to create panic, then cancel them milliseconds before execution. No metal changes hands, no real selling occurs, only fear. The charts are being gaslit, traders are being psychologically attacked. The illusion being created is that everyone is rushing for the exits, when in reality, demand is overwhelming. This is a coordinated effort to shake weak hands out of the market before the system loses control entirely. At the center of this betrayal stands the exchange itself. The COMEX is supposed to function as a neutral referee, ensuring fair and orderly markets. Instead, it has revealed itself as a captive institution. The exchange is owned and controlled by the very banks it is meant to regulate. Its board is filled with former executives from JP Morgan and Goldman Sachs. When rules are changed, they are not protecting market integrity, they are protecting their own survival. By raising margins and restricting trading, the exchange has violated its fiduciary duty to the public. It has proven that the paper silver market is not a place for honest price discovery. It is a casino where the house ejects players the moment they start winning. Whatever legitimacy the COMEX once claimed died this morning. History doesn't repeat, but it rhymes. In 1980, the Hunt brothers drove silver prices toward $50. The banks faced catastrophic losses. The response was identical. The exchange implemented liquidation-only rules under Silver Rule 7. Buying was banned, selling was forced. Prices collapsed from $50 to $10 in weeks. The banks survived. The public was wiped out. The cartel believes the same playbook will work again. But this time, the environment is fundamentally different. In 1980, demand was speculative. Today, demand is industrial. You cannot issue a margin call to Tesla. You cannot tell Apple or Samsung they are liquidation only. These companies require physical silver to manufacture real products. No rule change can override physics. The most damning evidence of fraud lies in the widening gap between paper prices and physical reality. While the digital silver price is smashed lower, physical metal tells a completely different story. Try buying a 100-ounce bar today. Dealers are charging premiums of 40 to 50% above spot. Why? Because the spot price is fictitious. It is a number agreed upon by insiders who do not intend to deliver metal. The real price of silver is what you must pay to take possession. That price is rising rapidly. The market is bifurcated into two realities: the banker's price on a screen and the people's price in the real world. The paper market has become irrelevant. Traders must now understand the next escalation. Hidden within the exchange's user agreement is a clause known as force majeure. This clause allows the exchange to void contracts during an emergency. If prices continue rising despite manipulation, the exchange may simply declare that silver cannot be delivered. Traders will receive a cash settlement based on a rigged reference price. This is legalized theft. The vaults are empty. The exchange knows it. The rules are being rewritten to shield institutions from accountability when delivery failure becomes impossible to hide. They are preparing for a controlled default. Whereas the media outrage, it does not exist. CNBC, Bloomberg, and the Wall Street Journal remain silent. Margin hikes are ignored. Supply shortages are dismissed. Instead, coordinated narratives appear labeling silver a meme trade or a dangerous bubble. This silence is purchased with advertising dollars. Banks fund the networks. The networks protect the banks. Why are they willing to risk exposure, lawsuits, and public fury? Because JP Morgan is trapped. It holds the largest short position in the history of the silver market. If silver reaches $100, losses exceed Tier 1 capital thresholds. In plain language, the bank fails. Regulators know this. The Federal Reserve knows this. JP Morgan has been deemed too big to fail, and the market is being rigged to save it. This is no longer a battle with a bank. It is a confrontation with the combined power of the financial elite and the state. But one major player does not operate under American rules: China. The Shanghai Gold Exchange exists outside COMEX jurisdiction. When the West suppresses prices, China increases its buying. Artificially low prices allow China to drain Western reserves. The Chinese government actively encourages citizens to accumulate precious metals. While the West plays paper games, the East stockpiles reality. By cheating, American banks are handing the future monetary system to their rivals. They are trading long-term dominance for short-term survival. Industrial users are also reaching a breaking point. Companies that rely on futures markets for hedging can no longer plan when prices are manipulated. Rumors are already circulating that major manufacturers are bypassing COMEX entirely and negotiating direct contracts with miners. If industrial users leave, the exchange becomes obsolete, a hollow marketplace trading nothing but promises. The banks made a fatal miscalculation. They believed rule changes would frighten retail investors into submission. Instead, they ignited fury. Online forums and investor communities are exploding with outrage. People are not selling. They are withdrawing funds and converting paper claims into physical metal. This is no longer just a trade. It is a movement. Every act of manipulation validates the thesis. Every rule change radicalizes another investor. Trust in fiat currency is collapsing in real time. The banks want you to believe they are all powerful, but their desperation tells the truth. Margin hikes, spoofing, restrictions, these are not signs of control. They are signs of panic. The system is cracking, and silver is exposing the fault lines.